Welcome to the Fear and Greed Daily Interview. I'm Sean Aylmer. On Mondays, we often look at markets and investing, and today I want to take a broader look at some wealth creation strategies. Almost all of us are in the stock market one way or another, many through our superannuation funds. Even if someone else is managing our money, it's important to understand how things work and how wealth is created. To help out, I welcome to the virtual studio Peter Switzer, founder and director of the Switzer Financial Group. He's a TV and radio broadcaster, economist, author, and podcast host, and many years ago, my first ever economics tutor. Peter, welcome to Fear and Greed.
Great pleasure to be with you, Sean.
So how do you make money in the stock market?
I think it's pretty easy once you've been shown how to do it properly. I think too many people treat it like going to the races on Randwick Day, like the Everest or the Kosciuszko, where the horses are, there's many of them, there's many chances to lose. And I think people try to punt the stock market as opposed to invest in the stock market. And I think there are easy ways to start, but I think the most important rule to start off with is always invest in quality companies. Once you've made a bit of money and you're feeling comfortable, you can do some speculative trades like some people did with unknown companies like Afterpay 3 or 4 years ago. By the way, that was started by another student of mine, Anthony Arson.
Oh, really? Scott Morrison was a student of yours too, wasn't he?
Yeah, he was as well. So was David Tudhope from Macquarie Telecom and
Wow.
Paul Bowen, who started M2. And I remember this. I was lucky to teach at the University of New South Wales, and very good students like you went through that commerce faculty. So
We digress.
Yeah. All right. But I think it's not actually an enormous digression, because I was saying that I was lucky to hang out with people like you, very good quality students. You had to get a reasonably high mark to get into commerce at New South. And as a young tutor, I realised that the people I was talking to were really good quality performers, and I had to be really well trained. So in trying to make things that were difficult easier to understand for people like you, it really pushed me to my limits. And I had to become, I had to say this immodestly, a quality performer, or I wouldn't have lasted.
Yeah.
And I think when it comes to investing, the same thing applies. There's silly ways of investing. That's like going to the races and backing a long shot and keeping your fingers crossed, or actually learning from the best out there, people like Warren Buffett, some of the great fund managers out there like Hamish Douglas. All these people are there, and the lessons are there to be learnt by people who understand that getting rich or getting wealthier from the stock market is a process of investing in quality companies. And I always throw this in, Sean, invest in quality companies when the market is really selling them off irrationally. And the best example of that was after about March 23 of last year, when the coronavirus crash took unbelievable price levels off fantastic companies. And that was the best time to buy. And that's when the inexperienced were not buyers. They were panicking and they were missing out on fantastic opportunities.
Okay, so there are a few things in that I wouldn't mind unpacking. Are we talking about long-term investing or short-term investing? Can you make money from short-term investing?
If it's short-term investing, I call it trading. I call it speculation.
Yep.
We don't know what's going to happen to a company in the short term, but I tell you what, you can pretty well guess what's going to happen to a quality company in the long term. And because I always say, don't ever put your bet on any one quality company, because a quality company, things can go wrong. Government policy can change. A stupid CEO could be made CEO who makes bad decisions. And I'll give you a classic example. AMP was once a quality company, but a series of things that went wrong over time changed that quality company. Now, if someone had, say, for example, 10 or 15 years ago, listened to people like me or others who said, look, have 10 or 20 companies, have 5% exposure to each one of those companies, you only would have lost on that 5% exposure you might have had to AMP. The other 19 probably was CBAs and CSLs and Blue Scopes and whatever, and they've done well.
Yep. Another part of what you said a moment ago, you talked about March 23, which was the very bottom of the market last year. Hindsight is 2020. How do you know when a market is at its bottom or is undervaluing?
You don't. You don't. But my attitude was this, Sean. The GFC, which you know very well because you would have been writing about when it happened, the low point of the market lasted a long time. It went from November 2007 to March 2009. And there were a series of drops along the way. And that was understandable because things went wrong over and over again. Bear Stearns collapsed, then Lehman Brothers collapsed, then government policy was hopeless and slow, and central banks, like even our Reserve Bank. In 2008, in February in The Australian, I wrote a story saying, why are we raising interest rates when we should be cutting interest rates? And a woman by the name of Philippa Malmgren came from the Economist Group in London, former advisor to George Bush Jr. I won't hold that against her. But she came in and addressed a group of economists like us, media people, for Deutsche Bank. And she actually said, your central bank's going to have to turn on a dime. That was February of 2008. Ironically, I think it was September that the Reserve Bank actually started cutting interest rates and was the first central bank in the world to do it.
Yeah.
So the GFC was a really hard one to work out, but there were things progressively going wrong. With the coronavirus and the crash, that was government created. The virus is a big problem. We have to close down economies, close down businesses. Why wouldn't the stock market crash? But as soon as we realised that governments were going to adopt basically a full-on Keynesian solution, throw a heap of money at it, bring interest rates down, it was logical that the stock market was going to boom. Though I didn't buy on March 22, but by about April 7 or 8, I could see the trends were going up. And that's when I started making my bigger bets on companies like Webjet, which I wouldn't normally buy, but at $1.20, to me, it was a very good buy. What CBA got as low as $50-something, $57, something like that. These were all good opportunities to buy. I don't put Webjet in the quality group yet. One day I think it might be. But companies like CBA were there for the buying. Wesfarmers, Woolworths. It was just money for jam.
Okay. Stay with me, Peter. We'll be back in a minute. My guest this morning is business and finance commentator Peter Switzer. Can a retail investor like yourself beat professional investors? Should I be using a managed fund? Yeah,
definitely. In fact, history has shown that passive investing in index funds will probably mean that you'll beat 2/3 of fund managers. Doesn't mean you beat all 2/3 of fund managers, because some fund managers will be in the winning third better than index funds, while others will not be. Then 2 years later, it could all flip around. So I think the retail investor, as long as they don't try and get too greedy, can at least get some very good returns by being in an index fund. And I must admit, in my early days, because I'm not a serious risk taker when it comes to investing, I used index funds, particularly when the ASX 200 was sold off during the GFC, bought an ETF for the ASX 200. Why? Well, I'm getting the best 200 companies in Australia, and I knew it would do well over time. But when it comes to international, I'm not real good at that. So I look around for great fund managers. And so in our financial planning business, Sean, for our clients, we use Magellan because Hamish Douglas has a great track record. Hasn't had a great year, but historically great track record. And we use an American fund called WCM, which has a couple of listed products in Australia and have outperformed just about every international fund for about 10 or 15 years. That's why I balance it up. I get the extra grunt from great fund managers, but I get the core of my returns from index funds.
Yeah, okay. I mean, you've watched the market for a long time and you've met many of the participants. You mentioned a moment ago management, and then you referred to AMP, though not in the same sentence, but I think we were going there. How important is management in an organisation?
Yeah, it's one of the things that I first learned from Warren Buffett, that you have to really believe in the calibre of the management. And AMP has really had a succession of really bad management ever since it's listed. And it may well have been bad even before then, but when a company gets on the stock market, as you well know, there are so many eyes on that company. And that's when, I'll use Buffett line again, that when the water goes out, that's when you see who's swimming naked. Well, AMP, he actually was showing us swimming naked even before the water went out with recession and crashes. And then the interesting thing is that even by putting someone like David Murray, who's clearly a very smart performer, he couldn't rescue the company. He was in such dire straits. Problems had gone wrong with it for a long time. And unfortunately, people chase AMP because it was a dividend payer. And that's the income trap, that some companies will pay dividends, but it's only because they're just really whittling down their profit and not going anywhere. And I think management ultimately shows you how good they are when you look at the growth of their earnings, the growth of their, not necessarily a dividend. The dividend can be another indicator, but I think growth of earnings is a critically important indicator to look at. And of course, you've got to compare it to the debt levels and things like that. But earnings per share is a very, very important indicator of whether a company's in the right direction or not.
The other thing I just want to ask about is animal spirits, entrepreneurialism, which as an economics student under you, we learnt a lot about entrepreneurialism and animal spirits and how important it was to make the economy go round.
Yeah.
Is that still the case in quality companies?
I think so. And what we've seen, I think the best examples of that, Sean, and we've got them here, like I think Afterpay is a case. I think the guys at Zip are very entrepreneurial and they've been able to translate that to the stock market. But, the classic ones are the FANG stocks plus Microsoft in the USA, all out of entrepreneurs, all have been able to go from being a private company to be a public company. They've kept growing their business. And I tell you what, when you think about those companies, I learned something that I really didn't fully understand only until a couple of years ago. And I may well have been doing it by some innate understanding. And I often will bring up Warren Buffett because I learned a lot. I didn't learn anything about the stock market at university, but certainly from great investors I did. And he always said, look for companies that have a moat around it. Now, okay, a moat is a protection, protecting the profits, protecting the potential of the business. But then I encountered these guys from Laguna Beach, California, WCM. And these guys are, as I pointed out earlier, really great fund managers. What they do, they look for best-of-breed companies around the world. At one stage, CSL was in their stable of stocks. But what they actually look for is companies that have a growing moat. So the moat is like a competitive advantage. Get a company where the moat's growing, they're growing their competitive advantage. Companies aren't able to catch up with them. They do extraordinarily well. And one of their best selections about 5 or 6 years ago was a company I'd never heard of before called Shopify. And Shopify basically copied the Amazon model for consumers, but brought it for small businesses right around the world. That's the kind of thing that I'm looking for. Management that have A, a moat, but B, a growing moat, getting more and more competitive all the time. And if you're always looking for those sort of companies, I think generally you will do very well.
Peter, before you go, I have to ask you about cryptos. What do you think of cryptocurrencies?
Don't understand it. Really wished I'd fallen into cryptocurrency when I interviewed them on my old Sky Business program. There was one of the early presidents of the Bitcoin Society of Australia, whatever it was in those days, came on the program and talked about a publican in Woolloomooloo who was actually accepting Bitcoin from backpackers for overnight stays. And I think at the point in time, Bitcoin was worth $250.
Oh, wow.
Yeah. But even then, $250 seemed like a lot of money. Like compare that to the usual share price out there. You know what? I got a sneaking suspicion Bitcoin will survive all this, but there's no way in the world I will invest in it, nor will I recommend anyone to do it because I simply don't understand the competitive environment in which it operates in.
I'm with you on that. Peter, thank you for talking to Fear and Greed.
Great pleasure.
That was Peter Switzer, Director of the Switzer Financial Group. You can read and watch more from Peter at switzer.com.au. Now remember also, there's no substitute for professional advice, and whilst you may have enjoyed our conversation then, I'd highly recommend speaking to a financial planner before making any investment decision. This is a Fear and Greed Daily Interview. Join me every morning for the full Fear and Greed podcast with all the business news you need to know. I'm Sean Aylmer. Enjoy your day.